Hello everyone, my name's Perry, and I want to welcome you to the PIIverse. This is my YouTube channel that basically focuses on my journey through my passive investing using covered call ETFs as basically the main investment tool in my portfolio, and some of the journey, some of the learnings I've had, and then also what is the strategy behind how I'm doing my stuff. Anyways, today's little video I wanted to create is almost like a follow-up. It's going to basically be a follow-up to the video I created last week and had a lot of attention. And it's basically going to be called, What About the NAV Erosion? It's going to be debunking some of the FUD that I saw in the comments in my videos. And I'm going to say 2 videos, and we'll talk about that right away. Anyways, so what we're going to do is we're going to talk about some of the questions, the challenging questions that were asked since the video that I put out last week, and I'm just going to put it out here. This is the video that I released a week ago today, basically. I sort of felt that this one was going to be popular because I knew what the topic was about, but I was overwhelmed at how popular this video has become. In like 1 or 2 days, it already dwarfed or surpassed my other video, which was around for 12 days. And in 2 days, it already passed that. This video alone was so popular that you guys and your interest in this video basically turned my little 6-week-old YouTube channel into a monetized channel. YouTube just congratulated me for reaching the milestone. And I have to thank this video, and I have to thank you people all for subscribing to me since then, for your interest in the video, which was basically a video that focused on my strategy. So that's why I called it the PIIverse Playbook. It is the full strategy on how my $1.5 million portfolio is generating $40K a month and growing. And it doesn't say that there, but we're going to talk about that too. I went through basically soup to nuts on this video. I talked about what my goals are, and then I walked everybody through my strategy from my goals all the way to how it's gotten the results. If you have not watched this video, I'm going to put it up in the corner right now, and you can click it. And I'm going to also right away, honestly, if you have not seen this video and you're watching this video that you're watching right now, and you have not watched the video that I'm showing you here, this PIIverse Playbook, I would suggest that you stop watching this one and watch the video that's here that I gave you the link to. If you've already watched that playbook video, the other video that you need to watch before getting into this one, because the two basically work hand in glove with each other. It was the one that I released about 3 weeks ago, and it was the concept that covered call ETFs should be treated as annuities, like perpetual income generating assets. Very controversial to a lot of people that would like, no, you can't do it. They're not, first of all, they're not annuities. I got a lot of people that could not grasp the concept between conceptual and actual, like feature to feature. This was not a feature comparison. It was basically a conceptual concept idea proposed that why can't covered call ETFs be treated like annuities, in the sense that they both could be treated as perpetual income generating assets once you pay for them in the front end. Anyways, there's a link to it up there for this one. Like I said, watch this video and also watch the playbook video before even continuing, and then come back to this video, because the debunking of some of the FUD is in the comments of both of those videos, and it's maybe good that you understand both of these videos before we continue on for you. All right. So if you guys have already done that one, I'm going to keep this one up while I'm talking. So some of the questions that came up, and a lot of them I know, like I said, 95% of the comments that I got were very positive, very like, oh, that's inspirational. I love the idea. I like to hear how a strategy is wrapped around covered call ETFs. There's a lot of people that don't understand still the intimate workings of how covered call ETFs are. They are a different beast, so it's not like a bond or a share of a company or a stock. They are they are unique, for sure unique. And if you don't understand how they operate properly, and even the people that think they know how they work, I've seen a lot of people that don't understand exactly how they work, because you wouldn't get a lot of the questions that I'm getting on my comment feeds on my videos if they actually did know how Covered Call works. So my strategy, again, is focused on that. So I want to, before I go into some of the questions that were asking things about erosion and NAV and stuff like that, and basically people saying that my portfolio is headed towards a NAV graveyard. Good terms on there. I want to first quickly talk about what the highlights of this strategy is that we're talking about. So again, if you watch the video, you're going to see that my whole portfolio is designed, my goals, and my primary goal is to generate income. It is not to generate capital NAV or capital appreciation. That is not my objective. And I think that's the hardest part, that some of the people that are asking the questions about NAV erosion and NAV graveyard and what happens when an ETF goes to zero and stuff like that, they're the ones that still cannot really understand the concept of an income investor. An income investor is not trying to what's the best way to word it? They're not trying to accumulate wealth. They're basically trying to structure a portfolio so that it starts basically paying you. You're consuming your wealth. Now, doing it in a most effective manner is what the key element is. And an income strategy, especially with the use of these innovative, game-changing investments called Covered Call ETFs, have really made the job of consuming your wealth to provide a long-term income stream just an amazing strategy. But in order to do that, you have to have a strategy that's wrapped around these Covered Call ETFs. You can't just turn around and say, I'm going to buy all of Misty, or I'm going to buy all of one ETF, Covered Call ETF, because it has so much yield and I'm just going to live off it. You need a full strategy wrapped around it so that you know that you can address the risks, you can address the yield, and you can address the income growth, not the NAV growth, the income growth. Again, explained in my portfolio strategy playbook. So when that's being said, again, most of you understood what I was trying to say, and really we're understanding the idea that the whole strategy is focused on generating income, maximizing income, growing income, right? You'll actually see, and I pointed out in this video several times, that you will not see that any of my goals are to maximize or to accumulate capital NAV. Matter of fact, it's not even mentioned as a goal at all. Like NAV of the portfolio or of one of my investments is not actually even a goal of mine. So that's the first thing I want to point out, that the video very clearly pointed out. And even the other video that I pointed out, the one which said here, these Covered Call treated as annuities. If you watch both videos, they both focus on the idea that NAV and NAV erosion are two factors that are not a major concern of mine, because there's a strategy to deal with it and to keep growing my income from year to year, regardless of what you look at as capital NAV, right? So what I'm going to do, I'm going to, as I want to talk about some of the questions that were being asked or challenged, I'm going to use my Snowball Analytics, which is the website, the site that I use that tracks my entire portfolio. It's been tracking it for over two years now. I started using it, I think, in late 2023, right when my portfolio, I guess, reached that cruise control mode. In all of 2023, I was basically building it from starting out the construction of my portfolio in February, and it came to that level of maturity that it basically was, I'm finished maturing and structuring it, and now I'm in the process of just maintaining it. And that happened about November, December of 2023. Snowball Analytics has been watching and tracking all my transactions since then, so it's a good tool for me to try to show and demonstrate to people some of the FUD about NAV erosion and when ETFs all go to zero and stuff like this, and how am I going to maintain my income in bad markets and stuff like that. So So let's go through some of this. And again, I know there'll be more questions after. So what I'm going to do is I'm going to take you all to my Snowball Analytics. Okay. So this is the main page of my Snowball Analytics, and I'm going to go through some of the highlight metrics. I did do this already in one of those other videos, but I'm going to do it again and try to maybe highlight the things about some of the terms that are bringing up. So the first thing that people keep talking about, and I think it's the number one, I guess, FUD, or the number one complaint that people say that, Perry, your strategy is not going to work. It's going to erode to zero. This is not going to happen. It's not going to work. You're all doing good because the bull markets are there, stuff like that. And look at your erosion already. Okay, so let's go through some of this. First of all, everyone seems to always talk about, well, what's your total return? Well, my portfolio's total return right now to date is 32%. My IRR, which is my projected internal rate of return, that means what does Snowball Analytics, when it looks at my entire portfolio, think that my total return is looking forward? And it's basically saying my IRR is 22.39%. Now, you can see that my current holdings have a minus 14, but even with a minus 14, and if you want to call that the NAV erosion, it's the capital loss that's basically between my book costs and my current value. You can see that that's minus 14. But even with it being minus 14, my IRR is still 22% because the income being generated is dwarfing the capital losses that are incurred underneath that. You also got to take in mind, and I'm going to bring this out a few times in my Snowball demonstrations here, that I'm also, since January of 2024, withdrawing money out of my distributions every month. And some of them are not just a little bit. Some months over the last 2 years were quite big. Like I'm almost withdrawing all of it for about 3 months last year. So you got to keep all that in mind, that my portfolio, first of all, is self-funded. Nobody asked that question, but I'm going to answer it for you right now. My portfolio does not take in any external sources of income. I'm retired. I've been retired for 2 years. I don't have any external sources of new income or new cash to put into my portfolio. So when you're watching this video and watching all my metrics, keep in mind that this portfolio is growing without any external sources of income or external sources of contributions. It feeds itself. It's self-funding. All right. So that you want to keep in mind when you watch what some of the metrics are that I'm going to show you. Over here in the value, you see that the current value of my entire portfolio is $1.59 million. You can also see that the total invested, that's how much I've invested in this of all my assets, is $1.84 million. So right there, I know a lot of the growth investors are going to say, oh yeah, look at that. How good is this? You're already down like 200 and something thousand. And I'll tell you exactly how much I'm down, because if I highlight this one here, my capital gains from my book cost to my current value is minus 249,000. So I am down $249,000. Now, even though I'm down $249,000 since inception, you might want to quickly look a couple lower. I have realized a capital gain of $94,000, and I have received $746,000 in dividends received. So when you look at the total returns, and this is what they keep, a lot of the naysayers about covered call ETF strategies and portfolios is, you got to look at total return. You got to look at total return. Okay, well, I'm looking at total return right now. And right now, my total return, even with my portfolio having a $249,000 loss against my capital, my current value, I'm at 32%. My IRR is 22%, which is my forward-looking projection of 22%. And my current yield is 38.5%. So it's projecting that even though I don't put any new money into this, even though my capital loss, and I know some people will refer to that as erosion, but it's just a capital loss. So erosion is a factor of it because there were some ETFs that I have that actually incurred an erosion factor, and I will talk about that later as well. But even with all that, I'm still maintaining a 38.5% yield. And it's projecting that I will, over the next 12 months, generate $582,000. And we'll talk more about dividends right away. I'm going to go pass through some of these. Some of these are screens that have no interest. So one of the things I mentioned in my video was the fact that my number one primary goals, other than obviously the risk, mitigating risk of the portfolio so they can run, perpetually until I'm like 90 or whenever I might croak, I want to generate maximum yield, and my second primary goal was to grow my distributions on a monthly basis. Well, this portfolio has been running, like I said, since, I'll say maturely, since right about here, this first bump right here, which is December 2023. So if you look at December 2023, I can't go over it because then it'll go put a bunch of names on top. But if you look since December 2023, I think I've met my first goal, which is basically that says that I want to attain income growth, not NAV growth. I want to maintain income growth. And you can already see here what my growth has been. It has its up and downs. And, a lot of people say, well, what happens on bad markets? Well, 2023 wasn't a great market year either. I mean, it was no 2008 and it was no pandemic, but it wasn't the greatest year either. But if you turn around and look, you'll see highs and lows happening all over the place. 2024 generally was pretty stable, and actually near the end of 2024, there was a lot of growth. Of course, with NAV growth, you'll also realize that when a covered call ETF is growing in its capital growth or in its NAV, it's also going to generate more income. So a declining covered call ETF will generate less monthly distributions, and that's because the underlyings are going down. And when you write covered call contracts against a smaller or a lower cost or lower priced underlying, you're going to get less distributions or less proceeds from it, because you're basically writing contracts under lower priced underlyings or equities. And of course, conversely, if a covered call ETF has underlyings that are starting to skyrocket, let's say like Misty did last year and stuff like that, you're going to be able to get more distributions because you're writing contracts on something that, one, is the most important thing, more volatile. But the other thing is it's also on against big, higher priced stocks, which means you'll also get more proceeds on it. Again, volatility and the price of the stock, you combine those, you'll get better distributions. If you see lower volatility on a covered call ETF, like an ETF that or a lower, sorry, I'm getting this. If you see lower volatility on an underlying, let's say like Misty or Coney or Coin or whatever like that, you're going to see lower distributions because the more stable it is, the less you can get out of the covered call contracts. So there's many factors that dictate how much distributions covered call ETF contracts can get off of their underlyings. And the two primary ones is volatility of the underlying and the price of the underlying. When an underlying price goes down, the ETF will go down because the NAV is based on the underlying's price. So of course, if that's going down, so will the ETF go down that holds the underlying. All right. But if the most important thing you see here is, even though you see ebbs and flows, what you will see from over here, which is January, or let's say here, January 2024, when it was at 12,800, to over here, which is this last month, which as of right now, as of today, August of 2025, I've generated already 46,000. But what you could already see is the growth of my yield is happening. Now, the growth of my yield is happening, even though, people already pointed out earlier, even though you saw that my NAV erosion was happening, quote unquote, I'm down to $145,000. But the other thing you don't see here, it will show up in the growth. So I'll show you up in the growth thing. So So you'll see that over here that basically I am growing my income. And again, that is my primary objective, is to grow my income. Let the cat out of the bag. It will be higher this month. So I already broke a record as of this week that August 2025 is now the largest income generated month on a 4-week cycle. August is a 5-week cycle, so it's actually cheating. So I can't even count next week for a normal 4-week cycle. But $46,000, which you can see right there, that is now set the record for the largest monthly income that my normal month has generated in my portfolio since I started. It will actually exceed $50,000 next week because there is a 5-week cycle, but there's not that many 5-week cycles months in the year. This bump you saw here, it was another one of those 5-week cycles. So if anyone's asking why was it so high here, it was because May was another 5-week cycle. You can see it was 49,000, but that was based on 5 weeks. August will exceed 50,000 based on 5 weeks. It should, I'm just guessing, somewhere around 51, 52. So it is growing. That's the important thing I wanted to show here. You could also see the chart here. You could see from 2023, the orange lines are getting bigger, but they're not as big as the blue lines. The blue lines were very good. That's where I got lots of growth. And actually November of 2024, October, for those that remember, that was actually a very good couple months for the markets. And you could see it respectively, my distributions were good on that month. So for anyone that asks like, well, what happens to your distributions when the markets are low? Well, naturally what's going to happen, just like pretty much everything else that happens, NAV drops, but so will distributions drop. So everyone's point, like, it's almost like, well, yeah, nothing's going to happen to me, but what happens to you? Well, look, if the markets are down, so are the growth investors' portfolios down. They're down 20% as well as mine's going to be down 20%, and my distributions will be down 15, 20%. But that's why one of my other goals in my portfolio strategy is to make sure I attain a yield that exceeds at least 3 times my monthly living expenses. And I do that for a reason, because when markets are low and markets are really down, and let's say they're even down for, 3, 4, 5, 6 months, if my portfolio currently is generating 46,000 and then all of a sudden we have a market crash and everything goes down like 20%, well, my distributions will likely go down about 20%. It won't crash to zero. I know there's a lot of the Covered Call ETF doubters and disbelievers that say that, oh, when that happens, all these Covered Call ETF strategies and investors are going to be crying because their whole portfolio is going to collapse. It's not going to collapse. It basically is going to do what happened during the Liberation month when Trump introduced all these tariffs, and we saw that big crash that happened in basically in March, sometime in March. Well, you can see what happened here. Forget about May. This was January, February, and when the tariffs showed up, this was what happened to my portfolio. Sorry, I apologize that these dots show up here. But this is what happened when the tariff showed up on the Liberation month. You can see in March, my portfolio dropped from February, which was I was earning 39,000. It went down to 33,000, and you can see the following month it went to 34,000. And then basically the market started picking up again. And again, I know May is an exception because it says 49. But even with that 5th week gone, I still would have exceeded 40,000. So for the same reason that during bad markets, a growth portfolio will drop in its NAV value, so will my distributions drop. But they're not going to keep dropping. They will drop until the markets come back up. And then basically my distributions will come back up. And you can see that that's happening because in June it was 36. Then in July it was 38. And then already August I'm at 46, and I'm going to actually be exceeding 50. So it moves slowly, but the distributions come up and down with the markets. And so to answer that one question, one that says, aren't you worried when the markets crash? No, I'm not worried that the markets are going to crash because I've built a strategy that says I'm protecting my monthly living expenses by doing at least 3 times my monthly needs. and I'm exceeding that. I'm over 4 times my monthly need. I could have my distributions drop from 40,000 to 25,000, and I'd still be doing very well. And it would have to be a pandemic level crash to make me go down to about 25,000. But again, that's still double the amount I need to exist. So that is why I'm not worried about market crashes, because honestly, I know there's people that think it's going to go to nothing. That's not true. They'll just collapse and they'll go down and depress, just like the growth stocks NAV, portfolio NAV will drop when they have bad markets. And when the markets get better, they'll come up as well. All right, so let's go into some of the analytics. I just want to quickly show you here. I'm going to go into my dividends one. There's a lot of people, and again, I'm going to point out those that it's not those are just asking the simple questions. I can tell the difference between those that are just asking simple questions versus those that are basically repeating from an echo chamber from a group that are saying that covered call ETFs are evil and they're a scam, and there's that small community, and that's why it reflected a very small number of the comments in my videos. Very small. Most of them were extremely positive, but you could see the ones where they literally were using the same comments over and over. What happens when your NAV goes to zero? What happens when all of these erode to nothing? And those are the kind of echo chamber FUD that I'm going to challenge all the time. And that's what I want to do it. So they always will. The one thing that you're going to hear from people that don't believe in covered call ETFs is they always will use the worst example as the key to explaining why the whole concept of covered call ETFs being used as an investment is a bad idea. They don't use any of the good examples because that would not prove their case. So the one thing they want to turn around, and in my portfolio, I'm going to use it as the poster child example right now of one that is actually experiencing some current erosion. Again, I don't know why the Coney fund managers are having issues with this. Coney used to be a very good darling ETF that came from the Yield Max community, but for the last, say, 8 months, I don't know what's going on, but they don't seem to be actually recovering with their underlying like many of the others do. So I would admit right now Coney does look like it has an erosion issue, and I'm hoping that they're going to solve it. An erosion issue, first of all, when you see NAV erosion, a lot of times it's because the fund managers are either being too aggressive on their covered call contracts, and they're losing a lot of them. And when you lose a lot of those covered call contracts, you're not earning as much. And then unfortunately, what some might do as a counter to that, because they want to still try to offer some kind of healthy yields, they're going to offer distributions that sometimes exceeds the amount that they actually earned. So when you talk about a NAV erosion on covered call ETFs, a lot of times it's when the more aggressive covered call ETF funds are being too aggressive and are losing on that aggressiveness, and they're maybe paying out more than they should. And when that happens, you're going to see the erosion of it because they're paying out more than they earned. A lot of the ones that have given problems in the past have actually cleaned up their act. Coney is one that right now hasn't. I don't know why. I'm hoping they will. But the ones that have sort of cleaned up their act and were poster child examples of erosion was like Defiance's IWMY and their QQQY. They really were showing that erosion. They actually reverse split. Both of them actually reverse split. But in the last, I'm just going to say 6 months, I don't know the exact time frame, they have made some major changes and shifts in their prospectus and in their strategy. And so now IWMY and QQQY, they're not eroding anymore. They're very stable in their NAV. Unfortunately, for those that bought those two ETFs that were generating what we call 100% yields, they're not generating 100% yields anymore. Their yields are a very nominal, average type of yield. I mean, they're still really good yields, but at the end of the day, they're not what people were used to. But they are generating nice yields still, and they've stabilized the NAV. So when somebody says that all these covered call ETFs will erode to nothing, and they just point at one or two covered call ETFs and say, look at that one, that one's going down. First of all, even the ones that have had NAV erosion, They've not gone down to zero. The poster child example of one of those was Tesla, TSLY. It reverse split over a year and a half ago. I can't even remember how long ago. It's still, I don't own it anymore, but it's still producing nice monthly distributions, even though it reverse split. I have QQQY and IWMY. They're still producing reasonable distributions, even though they've reverse split. So the first FUD thing that I'm going to squash is the fact that they'll all erode to zero. They're not all eroding to zero. Unless you're going to delist the underlying, the chances of any one of these eroding to zero is, it would be the equivalent of saying I'm not going to fly a plane because I know there is a chance that a plane can crash. So I really challenge all these ones that are turning around and saying that they'll all erode to zero. Show me one. Again, I know a lot of the covered call ETFs, but show me one or two out of the thousands of covered call ETFs that are on the market right now, and they're growing really quickly, that basically have eroded to zero. I don't know one. You would shock the heck out of me if anyone on the, post your comments now if you know one or two. I mean, at the end of the day, if this is actual fact of what's going to happen, then we should have seen this happen already several times. We should have seen several covered call ETFs erode to quote unquote zero, and yet none have. And even the ones that basically have had some erosion and have had reverse split have stabilized, and they basically still produce it, which goes back to my first video about treating covered call ETFs as annuities, because even those covered call ETFs that have experienced some clear erosion and are still experiencing some right now, they will perpetually produce income even though they're at a diminished level. So yeah, they're not producing the 70-80% yields, and the, let's say like my Coney used to be offering me like $7,000 a month. It's now offering me about $2,000 a month. So yeah, it's not giving me the steady huge yields that it was. But that's not the key here. The key to this is Coney is still producing me a very nice income in my farm of sources of income that makes up my monthly distributions. So that's why it's so important to know with my strategy. I put a lot of diversity out so that I have, again, I think I'm at around 26 or 27 covered call ETFs. Every one of them is putting their portion of their contributions into the monthly bucket called distributions. If Coney's not contributing as much as it used to, that's fine. Would I like it to do more? Sure. But at the end of the day, it's still producing. And I'm going to show you here, this one you're looking here now for the past 5 minutes. You can see that in the history of my entire portfolio, look which covered call has generated the most income for my entire portfolio. It was Coney. Coney has contributed out of the $700,000 that is basically generated since inception. It's generated $88,000 into my portfolio. That's not bad. That's in my opinion, as an income investor, not a growth investor, income investor, it's definitely doesn't owe me much because it is generated quite a bit. So that's a key element to understand. The other thing you're going to see here, it's called yield payout. You'll see a lot of these little light blue lines. Those are signs of erosion or undervalued. So you can see Coney right now, my yield on cost is only 20%. Its current yield is 58%. So yeah, somebody's going to turn around that's a naysayer and say, yeah, well, look, you spent so much money on it and you're now only getting 20% yield on cost. And it used to, it used to be so big. Yes, you are right. That is the case. But it is still producing a current yield on cost for me at 20%. Name a dividend stock that pays out 20% yield. Find your best dividend stock from who knows, AT&T, whatever you want. Find me any one of them that can produce, even when it's highly eroded, can produce a yield on cost of 20%, or even a healthy yield at 20%. I can guarantee you none of them exceed 10%, and most of them are at the 5 or less percent. So I'm totally happy that even my eroded Coney is generating me at a yield on cost of 20%. All right. And then there's also the ones that people don't mention, and I would really love to do the whatabouts to the ones that turn around and say that they point at the let's say the ugly ducklings of covered call ETFs. Why do they never use covered call ETFs like PLTE or CNYE or some of the other ones like bank or call, that basically when you see the line above it, it means that they are actually they're worth more NAV than I paid for them, and they're also producing very good yields. So this one here is producing me a yield on cost of 39%, and basically the yield currently is 33%. So my yield on cost is actually greater on CYNE. You don't see any erosion here. So when you talk about all covered call ETFs will erode, again, let's strike another big FUD X mark across that. No, all covered call ETFs do not erode. Some of them actually gain so much that I have to actually trim their gains on it. So it all depends. And again, I got ample proof that shows that all covered call ETFs do not erode. Some do, most don't. Some actually do better than just generating income. They're actually generating me growth, NAV growth, and income. So, all right. So let's talk about growth, because again, a lot of these challenging questions are coming from those that are in the growth portfolio ecosystem. So let's talk about growth. So this is my portfolio since inception compared against the S&P. The dotted line you see is the investments that are being put in throughout the entire time. Now, from the beginning till about, like I said, till about here, November or December, this stuff is when my portfolio went from pretty much nothing to I was building the structure, I was building up my strategy, my portfolio, I was migrating all my old bank managed portfolios and accounts over into my new strategy. So you can see all of this happened. You can see it grew up really quickly here. That's when my pension was commuted and it basically was added to my portfolio. So honestly, my portfolio really didn't start until about here, November of 2023. After that, it was a lot of care and feeding. My strategy went into cruise control mode is the best way to describe it. And again, to understand how mine works, my strategy basically is that I'm trying to generate a yield of at least 3 times my living expense. The reason I do 3 times living expense, I explained to it earlier, is because first of all, I want a buffer in case some really bad markets like a pandemic or a bad market crash happens, so that if all of a sudden my monthly distributions drop from say 35,000 down to 25,000, I have a buffer that says, yep, I'm still generating 2 times more than I need to earn. The second reason I have a 3 times living expenses on my distribution goal is because all the money that exceeds the amount I need to live on, I use to reinvest back into the portfolio. I do that because I want to see my income growth happen. Again, that the NAV grows up with it is just a side benefit. I don't reinvest my excess distributions exceeding my living expenses so that I can increase my NAV. That's not my goal. My goal is that I can buy more covered call ETFs that generate more income on a monthly basis. And because you're buying more covered call ETFs that generate more income, of course, the natural side benefit is going to be that you're also increasing the NAV of your portfolio. But again, that is not the reason I'm reinvesting. I'm reinvesting so I could buy more covered call ETFs that generates more monthly money coming into my bucket, and then basically rinse and repeat. Use my living expenses, reinvest the excess part, next month moves on. Again, I don't have to do this because some people say, I've seen one question or one comment from somebody saying, oh yeah, if Perry has to basically reinvest all the money that he doesn't live on, so if he's only taking out 10,000, he needs the other 30,000 or his NAV is going to decline. No, it's not going to decline. If it declines, it's not a big factor. I do the excess over my living expenses because I don't need the money to actually live on. So why wouldn't I reinvest all of it so that I could actually generate more income, which increases my buffer to 4 times, 5 times, 6 times living expenses, so that it becomes less and less risky that if a major pandemic happened again, even if the markets dropped by 50%, my distributions would drop by 50, 60%, but I'd still be okay. So that's why I do it. I don't need to do it. I can literally, and in 2024, I actually did for, let's say, April, May, and June, I withdrew all the distributions for each of those months, 100%. None of it went for reinvestment. And I did that because we did a major kitchen reno that I literally paid cash for. And I did it by actually using all my distributions from April, May, and June. So there was no distributions in those 3 months of 2024. And then I did it again in September when I bought a hot tub. So that, again, I used all my distributions. So the fallacy that somebody says that I have to reinvest or my portfolio will go down is simply not true as well. I do it because I want to keep increasing my NAV. I want to keep increasing my income. And that's why I do it. And you can see it happening. Like if you could see this dotted line, I'm going to keep my mouse out of the way, otherwise it gets in the way. But you could see it happening where you see that little dotted line keeps going up, 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 up. And what that is, most times, there's a couple times it goes down. That's because I actually sold and did some swing trading on my Athabasca. But other than those, everything else you're going to see is an upward movement. Those are all my reinvestments. Every time you see that dotted line go up a little bit more, it's because I'm reinvesting my excess cash and you're seeing the dotted line go up. So, of course, as you do that, so people say, oh yeah, but you're eroding. Okay, well, here's me. Let's go back to January 2024. My portfolio was worth $1.372 million. My portfolio, let's go back to that. January right here. So my portfolio was worth 1.3 million, 1.372. I had total invested at 1.3. So I was actually higher than I was doing higher than than basically I invested. So I was actually in a positive. I actually didn't have a loss on I didn't have a NAV loss. I had actually a NAV gain. And I was actually exceeding the S&P on that one because the S&P was 1.34. I was at 1.372. So now, fast forward, that was 1.3. Okay, so let's go all the way over to the end here. Currently, I have invested, it actually should be 1.8. I can't get to the last dot here. There's a I can't get to it. Okay, anyways, it's saying it's 1.73, but I know it's actually 1.8 something. So 1.8 million is my current book value. So my invested means my book value. My book value has gone up from about $500,000 since back in December 2023. My portfolio, which was at 1.37, is now at 1.54. So for anybody who says that my NAV is going to decay and erode because all I'm doing is buying into these covered call ETFs, well, this is showing you that my strategy is delivering in not only the ability of producing, I'm going to say, significant monthly income that I can take out and enjoy my living expenses and give to my children and do things like that. But it's doing that and still growing. So the reason I'm saying that is since my goal is not to grow NAV, it's to grow income. If I decided I didn't want to grow income anymore and I just wanted to say, hey, you know what? I'm happy at 40,000. You know, if it stays between 30 and 40,000, I'm happy. I wouldn't have to reinvest. I would literally start almost say 80% of everything I would earn. I would basically out of the month, I would withdraw. And so I could basically, the NAV would then just sit stable. It would not decline to zero and go into a NAV graveyard, as people say. It would just stay relatively stable. And again, I'm not looking to accumulate wealth. I am retired and I'm generating income. All I care about is that my portfolio generates a 3+ times living expenses income. It does that in spades right now. So yes, I could remove almost all of my distributions every month. The reason I don't do it is because if I do that, it's in a sheltered account called a RIF, which is a Canadian registered retirement plan that actually pays out, retirement income fund. My RIF if I were to take that kind of money out every month of my RIF, I would be getting so taxed so badly, because I would be being taxed on about $300,000-$400,000 a year on money that I don't need. So basically, the main reason I don't take it all out right now is because I don't want to be taxed to death. It's growing inside a sheltered account. I'm happy taking out only the $10,000 a month, which is what I need to live on right now, and I get taxed nominally at that. If I wanted to all of a sudden say, hey, I want to buy a cottage or something, I don't know what, something really big, like a new car for $80,000, I could for 3 or 4 months take out all my distributions. I would be tax heavy for it because that money would then be taxed. So that is why I do not withdraw all my money out of my portfolio every month that I generate. It's for tax reasons and the fact that I want to keep seeing a growth of my income being generated. And that's what you see. The other thing you want to notice here is, notice the lines between the S&P and my portfolio. If even with everything that's going on, even with me withdrawing the money, you can notice that the S&P and my portfolio are not going in divergent paths. The S&P currently is above me, it says here, by $77,000, if you look up here in the top corner. So right now the S&P is beating my portfolio by 5.11%. Of course, the one thing that the S&P is not doing for me, even though it's gained that 70%, it's not paying me out a distribution of $40,000, $50,000 a month. So what my portfolio is doing, even though it's down 77,000 or 5%, it is generating income that the S&P would never do if I actually followed the orange line instead of the blue line. So that is why the income strategy for me is absolutely more valuable than following the S&P and doing a growth strategy, because I need income. The other thing that's tied completely to this is also, and I'm going to put the compare button on this one as well. This is showing my portfolio in portfolio performance on growth. You can see basically on from zero to how much money has been gained between the two. The S&P is doing it by pure growth. It's basically doing it not by reintroducing yields and reinvesting yields. It's doing it by growing its capital value. My portfolio in the blue is doing it generally by reinvesting its income yields that it's going back in here. The reason you see a gap here between the yellow and the blue, and this is going to be explained, let's go back to January 2024. You could see that before this line, to the left of this line, you could see that my blue line, in many cases until this date, was actually exceeding the S&P. So you have to ask yourself, why was my blue line exceeding the S&P until this point in time? Well, that is because until January 2024, I was not withdrawing any of my monthly distributions. They were actually being fully reinvested back in. So when my portfolio was actually reinvesting all its money back into its portfolio, I'm actually beating the S&P. So opposite of that is, as of January 2024, I was basically forced, and I had to because, one, I was retired, I needed money to live on. So anytime after this line right here, January 2024, my portfolio started being forced every month to pay out a minimum of $10,000 a month. And many times it was $20,000 a month. And there were times when it was paying out $30,000 a month. So every month that I go here, January, February, all these months, you can see that the yellow line is getting bigger and bigger. The gap is getting slowly getting bigger and bigger. Not that much. Sometimes I actually even catch up to the S&P. But the reason you're seeing that gap, that is my withdrawals coming out of the portfolio that can't be reinvested, of which the S&P is not burdened with that, because it says I'm not paying out anybody anything because I don't generate any kind of income for anyone to take. So the only way I could compare that is to have the S&P basically sell $10,000 a month or more of its assets and liquidate it and bring it out to me. And that, if I did that, the S&P, in my opinion, would be almost dead equal to my blue line. As a matter of fact, if I go before January 2024, I would think my blue line might actually exceed the S&P if the S&P was forced to liquidate I'm going to call it on their side, the 4% rule, and start liquidating its assets every month to pay me my living expenses. The blue line is doing that. And you could say, even though it's doing that, it is still keeping up with the S&P. And not only that, another important thing you got to look at for those naysayers, look at where I was before, look at where I am now. I am currently with a positive 33%, and the S&P is at a positive 39%. And even with all that, that is after I paid out about $333,000 of total money that has been withdrawn out of my portfolio since January 2024. And despite that, look at where it is as it compared to the S&P. If I actually put all that back in, I would only be about $5,000 or $10,000 below the S&P. So that, in my opinion, dispels any of the fears or any of the FUD that says that my portfolio will erode to nothing. It's not eroding. You can see it's not eroding here. It is actually going up. So I'm hoping this is going to dispel some of these fear tactics that they're going to go down. If there's a market crash, you can see it happen right here. So remember when we talked about, whoa, Perry, what's going to happen when we have a market crash? Well, okay, the tariff thing was a very short-lived one, but it was a very steep one. We saw some of the most significant declines in the global markets in a very short period of time. Well, this is what happened. You can see what happened. It did exactly in my strategy, in my portfolio, as the S&P did. Nothing went worse. You know, the argument was from a lot of these people that my covered call ETFs are going to basically collapse in a bad market. Well, they didn't collapse. They went down just like the S&P did. And when things started going back up again and the bull market, quote unquote, started showing back up again, both mine and the S&P went back up again. So again, this dispels the other rumor that basically if we have a bad market crash that anyone that's investing in covered call ETFs is doomed. No, they're not doomed. Again, if anybody is investing in one covered call ETF, bad on them. That's just a bad investment strategy. I believe very much in diversification. I have 26, 27 covered call ETFs all across the geographies, sectors, markets, strategies, covered call, perspective strategies. And if you really diversify and then constantly reinvest and add more to them, my strategy is not going to be vulnerable when a market crash happens. It's going to do this just like what happened to the S&P. That's what's going to happen to mine. It will recover just like the S&P recovered. Mine recovered as well. Okay. The last thing they talk about, they said I'm going to go into dismissing the FUD. Let's go into the last one, and they're talking about, oh yeah, but yours is a high risk strategy. Your strategy is so risky. You're investing in all these covered call ETFs and they're risky. Well, these again are metrics from Snowball Analytics looking at my entire portfolio, all of my entire portfolio. So the first thing they talk about, they're very volatile and very high risk. Well, okay, so here's what volatility and beta. The market is always deemed in a beta to be 1. Well, my portfolio is 0.238. In other words, my portfolio is far from volatile. It actually takes volatility out. And this has been proven time and time again that covered call ETFs basically reduce volatility and of a portfolio. They actually make them a lot smoother and a lot more stable than if you're basically investing in the S&P. And here's your proof right here. My portfolio's beta is 0.238. The S&P and the markets in general should be 1. If I was high volatility and I was high risk, I would be way up here in closer to 2. I'm actually closer to 0. The other thing that, again, people don't know this number that well, but that is again called the Sortino ratio. This is what basically compares the profitability, the risk reward ratio. If any investment or portfolio is over 2, it's actually considered good. The S&P doesn't even reach good. It's close. It's at 1.875. If it was over 2, it would be considered a good ratio for Sortino. Well, my ratio is 14.717. I'm off the charts when it comes to risk-adjusted return. So for anybody that says that a covered call ETF strategy is a high risk, Well, these two market numbers here are telling you a different story completely. It's showing that my risks are not there and my risk-adjusted return is off the charts. All right. I don't think I have anything more to say. I'm sure this is going to generate more questions. And I encourage it. I mean, at the end of the day, even for those that are the naysayers and don't believe in covered call ETFs and stuff like that, if they're turning around and saying these things and, even bringing up the FUD and bringing up the echo chamber, misinformation, it's good that they do it, because then people like myself and others can actually have a debate with them and basically show them that some of these statements are just not right, or they're basically skewed because they're taking it from the perspective of a growth investor. And again, the one thing I turn around and people keep saying, well, Perry, I know you say that you're not worried about NAV erosion, but you should be. No, I don't. And again, I don't know how many more times I can show you in my charts and in my spreadsheets and in my my analytics. At the end of the day, my portfolio is growing. My income is growing extremely fast. My risks are low. So at the end of the day, I don't know when these gloom and doom scenarios are going to happen. I've shown you what happens during a bad market downturn. You can see that it recovers quickly. But again, I can only just show you this. I'm not here to convince the naysayers. If that's, if they're growth investors, more power to them. I have nothing against the growth portfolio. It's great for them. It's not what I need. I need something that generates income. They need something that they believe needs to generate unrealized capital growth. That's the right strategy for them, and my strategy is right for me. So I'm hoping that helps. And again, I encourage you again to go through the two videos if you have not seen them, and then watch them carefully, because I do explain a lot of this stuff, but I guess I wasn't clear enough in some of it. And again, I hope this has helped. And if you guys, drop me some comments if this video was of any value to you, or if it was basically me regurgitating whatever Ray told you. Anyways, I hope you guys have a great day. Stay safe, stay invested, and I'll see you in the PIIverse.